The Federal Reserve, the European Central Bank, and the Bank of Japan are all moving in completely different directions right now. And if you are not paying attention, this policy divergence could wreck your trading account. Here is what is happening. The Fed is stuck. Inflation in the US is hovering stubbornly above target, but the labor market is finally showing real cracks. The Fed wants to cut rates, but cutting too early risks reigniting the inflation they spent years fighting. So they sit and wait, and that indecision is creating a pressure cooker underneath the dollar. Meanwhile, the ECB has already committed to its easing cycle. They have delivered multiple cuts since late 2024, and the eurozone economy is still struggling with weak growth. More cuts are expected. That means the euro is under persistent structural selling pressure against the dollar, at least on the rate differential alone. Then you have the Bank of Japan, doing the exact opposite of everyone else. After decades of ultra-loose monetary policy, the BOJ has been actively tightening. They raised rates, they unwound yield curve control, and the yen has been strengthening as global carry trades unwind. This is a complete reversal from the historically weak yen we saw through 2023 and 2024. Now here is where it gets dangerous and interesting for Forex traders. This kind of three-way policy divergence historically precedes major equity corrections. When central banks disagree this aggressively, global capital flows turn chaotic. Institutional money does not know where to park, and when the S&P 500 starts to wobble under that uncertainty, the chaos in currencies accelerates hard. So what do you actually do with this information? 3 defensive setups worth watching. First, watch Euro-US dollar for a sustained breakdown below key support. If the ECB keeps easing while the Fed holds firm, this pair has room to fall. A clean break below 1.08 opens a path toward 1.05, and that is a trend you want to be positioned for, not against. Second, keep usdjpy on your radar for a potential short setup. If the BOJ continues tightening and global risk sentiment deteriorates, the yen strengthens fast. We have seen this pattern repeat during every major risk-off event in the last decade. A drop below 145 could accelerate quickly toward the 140 handle. Third, and this is the big one, gold. XAUUSD has consistently been the strongest safe haven during periods of central bank policy uncertainty, and right now we have genuine uncertainty from all 3 major central banks simultaneously. If the S&P 500 corrects even 10% from current levels, gold is likely pushing to fresh all-time highs. Watch for pullbacks to the 50-day moving average as potential entry zones. Here is the key takeaway. Do not trade central bank divergence blindly. Use it as a directional filter. When all 3 major central banks disagree on policy direction, volatility is inevitable. Position smaller than usual, use wider stops to survive the whipsaws, and let clean setups come to you instead of forcing trades. Follow hairy trades so you are ready before the next big move hits.